Something just happened that Wall Street does not want you to understand. Something that happened quietly inside the private strategy documents of the largest asset manager in the history of human civilization, a firm that controls more money than the entire gross domestic product of every country on Earth, except the United States and China combined. 13 trillion. That is how much BlackRock manages. And on the 23rd of March, 2026, in a strategic commentary that most ordinary investors will never read, BlackRock made one of the most significant portfolio pivots it has made in years. They moved to neutral on United States equities. They went underweight on long-term treasury bonds. They signaled they were preparing for something they called a stagflationary shock. And buried inside the language of their Q2 2026 equity outlook, released publicly just days ago, is a warning about regional banks that should stop you cold. Because what BlackRock is doing with its $13 trillion right now is the single most important signal in the entire financial market. When the largest money manager on the planet repositions, the money moves first and the explanation comes second. The question is never what BlackRock says. The question is what BlackRock does. And what they are doing in April of 2026 is a direct message about the safety of your deposits, the stability of your local bank, and the financial system that touches every single person in this country. Stay with me, because by the time this video is over, you will understand the signal, the system behind it, and what you need to do right now. Let us start with what is actually happening and why it matters to you personally. BlackRock is not a bank. It does not take deposits. It does not hold your checking account or approve your mortgage, but it does control where trillions of dollars move across the global financial system. And when that kind of capital starts shifting direction, it does not stay contained inside portfolio models. It flows through markets, through institutions, and eventually into the real economy. That means jobs, businesses, lending, and yes, your bank. And right now, that capital is quietly repositioning away from some of the most vulnerable parts of the system. Not loudly, not in a panic, but methodically. And that is exactly how institutional exits always begin. Before you dismiss this as just another market update, you need to understand something that most people only realize after the damage is already done. This pattern has already played out multiple times. Different decades, different assets, same sequence. In the 1980s, savings and loan institutions, the regional banks of their time, loaded up on real estate and collapsed when the environment shifted. In Japan in the 1990s, banks did the same thing, and the result was not a quick crash, but a slow, grinding stagnation that lasted decades. And in 2023, Silicon Valley Bank went from safe to gone in 48 hours. Not because people suddenly discovered risk overnight, but because the people closest to the data had already moved. That is the part that matters. The timing. Institutional capital does not wait for headlines. It moves before them, quietly, gradually. And by the time the average person hears about the problem, the positioning has already changed. And right now, we are back at the beginning of that sequence again. Here is the number that should get your attention. $875 billion, that is the amount of commercial real estate debt that needs to be refinanced in 2026 alone. Not over the next 5 years, not spread out across a decade, this year. And that debt was issued in a completely different world. A world where interest rates were near zero, property values were higher, and refinancing was easy. Today, none of those conditions exist. Interest rates are elevated. Property values, especially in office space, have dropped significantly, and lenders are becoming more conservative, not less. That creates a problem that feeds on itself. When borrowers cannot refinance at workable terms, loans start to go bad. When loans go bad, banks are forced to recognize losses or increase reserves. When reserves increase, earnings drop. And when earnings drop, stock prices follow. That is not theory. That is the exact chain reaction that has preceded every modern banking stress event. Now here is where it becomes more specific and more dangerous. Not all banks are equally exposed to this. Large global banks are diversified. They have trading desks, international operations, multiple revenue streams. Regional banks do not. They are concentrated by design. And in many cases, that concentration is heavily tilted toward commercial real estate. In fact, regional banks hold roughly 40 to 45% of their loan portfolios in commercial real estate. For large banks, that number is closer to 13%. That is not a small difference. That is a structural vulnerability. It means that when commercial real estate comes under pressure, regional banks feel it first, and they feel it hardest. And this is exactly the type of imbalance that institutional investors look for when they reposition. They are not guessing. They are analyzing exposure, concentration, and timing. What they are seeing right now is a convergence of pressures that is unusually aligned, because the commercial real estate problem is not happening in isolation. It is happening at the same time as rising energy prices, persistent inflation, tightening financial conditions, and increasing recession risk. Each of those factors alone would be manageable. Together, they reinforce each other. Energy prices have already surged due to geopolitical tensions, pushing inflation higher than expected. And as long as inflation remains elevated, the Federal Reserve is constrained. It cannot aggressively cut rates without risking even higher inflation. That means the relief valve that many borrowers are hoping for, lower rates to refinance debt, may not arrive in time. And every month that rates stay elevated is another month where refinancing becomes more difficult, more expensive, and in some cases, impossible. At the same time, liquidity in other parts of the financial system is tightening. Private credit markets, which have grown rapidly over the past decade, are beginning to show signs of stress. Large funds are facing withdrawal pressure. Some have already restricted redemptions, and that matters because regional banks are connected to these markets through lending relationships and credit exposure. When liquidity tightens in one area, it rarely stays contained. It moves through the system, creating pressure in places that most people are not even watching. And then there is the broader economic backdrop. Recession probabilities are rising, not dramatically yet, but steadily. And regional banks are particularly sensitive to economic slowdowns because they are tied directly to local economies. They lend to small businesses, they finance local real estate, they depend on the health of the communities they serve. When those communities slow down, the impact shows up quickly in loan performance and deposit stability. Now step back and look at the full picture. You have a massive refinancing wall in commercial real estate. You have elevated interest rates that are not coming down quickly. You have declining property values in key sectors like office space. You have tightening liquidity in private credit. And you have rising recession risk. That is not one problem. That is multiple pressures hitting the same institutions at the same time. And those institutions, regional banks, are among the least diversified parts of the financial system. This is what BlackRock is reacting to. And this is where the signal becomes clear. Because when an institution managing $13 trillion shifts its positioning away from areas with these characteristics, it is not making a random adjustment. It is responding to a risk profile that has changed. And that shift does not happen all at once. It happens gradually, through rebalancing, through allocation changes, through subtle adjustments that most people never notice. But over time, those adjustments add up. And the cumulative effect is that large amounts of capital move away from vulnerable areas before the vulnerability becomes obvious to everyone else. And that is exactly the stage we are in right now. And this is the part where most people misunderstand how risk actually builds inside the financial system. It does not begin with panic. It begins with quiet repositioning, small changes in allocation, slight reductions in exposure, a shift from aggressive to neutral. Each individual move looks reasonable on its own. Nothing dramatic, nothing that would trigger headlines. But when you zoom out and look at the aggregate, the pattern becomes clear. Capital is leaving specific areas before the broader market fully understands why. That is exactly what is happening now. And the consequences of that shift are not immediate, but they are predictable. Because when institutional capital moves away from a sector, it removes support. Prices become more sensitive. Volatility increases. And any negative development that might have been absorbed under normal conditions starts to have an outsized impact. This is how stability erodes, not all at once, but step by step. Now here is where the situation becomes even more important for you personally. There's a difference between market risk and deposit risk, and most people do not fully understand that distinction. If you own stocks, ETFs, or retirement accounts that are exposed to regional banks, those positions are directly tied to market pricing. They move up and down based on investor sentiment, earnings expectations, and capital flows. If institutional investors are reducing exposure to that sector, those assets are on the same side of the trade that is being unwound. That is market risk. Deposit risk is different, but it is not irrelevant. Deposits are protected up to certain limits, but confidence still matters because banking is fundamentally built on trust. As long as depositors believe their money is safe, the system functions smoothly. But when that confidence begins to weaken, even slightly, behavior changes. And in a world where moving money takes seconds, not days, that change in behavior can happen very quickly. You saw a version of this in 2023. It was not a slow process. It was not orderly. It was rapid, digital, and self-reinforcing. Once withdrawals began, they accelerated. And the speed of that process is something the financial system is still adapting to. Technology has removed friction. And when friction disappears, reactions become faster and more extreme. Now combine that reality with the pressures building in 2026. A large volume of commercial real estate debt that needs refinancing, elevated interest rates that are not falling quickly, property values under pressure, liquidity tightening in adjacent markets, and institutional capital gradually rotating away from the most exposed areas. Each of these factors increases sensitivity, each one reduces the margin for error. And when margins shrink, systems become more fragile. This does not mean that every regional bank is at risk. It does not mean that a crisis is guaranteed. But it does mean that the conditions that have historically led to stress are forming again. And the important part is not predicting the exact outcome. It is recognizing the direction of risk and positioning accordingly. So what do you actually do with this information? Not panic, not make impulsive decisions, but become precise about your exposure. Start by understanding where your money is. If your primary bank is a large, diversified institution, your risk profile is different than if it is a smaller, regionally concentrated lender. That does not automatically make one safe and the other unsafe, but it does change the variables that matter. Then look at your deposits. Know the limits, understand how they apply to your specific situation. This is not about fear, it is about clarity, because uncertainty is what creates bad decisions, not information. Next, separate your thinking between banking stability and investment positioning. These are not the same thing. A bank can remain operational while its stock declines significantly. And if you are holding exposure to that sector through retirement accounts or ETFs, you are participating in that price movement whether you realize it or not. That is where institutional positioning matters most. Because when large pools of capital rotate, they influence pricing across the entire sector. And this brings you back to the central signal. BlackRock is not reacting to headlines. It is reacting to data, to exposure levels, to macro conditions, to correlations between different parts of the system. And when those inputs change, positioning changes. That is how large-scale capital operates. At the same time, pay attention to where that capital is moving, not just where it is leaving, because that tells you how risk is being rebalanced. There's a shift toward assets that perform better in inflationary environments, a preference for shorter duration instruments that are less sensitive to interest rate changes, a focus on areas with stronger balance sheets and more diversified revenue streams. These are not random choices. They are responses to a specific set of conditions. And those conditions are not hidden. They are visible in the data. Rising energy costs feeding into inflation. Policy constraints limiting how central banks can respond. Large refinancing needs colliding with tighter credit conditions. And a gradual but noticeable shift in institutional behavior. All of this leads to a simple but uncomfortable truth. Financial systems rarely send clear warnings to the public, not because information is unavailable, but because it is distributed in ways that require interpretation. It shows up in positioning before it shows up in headlines. It appears in capital flows before it appears in narratives. And by the time it becomes widely understood, the adjustment has already taken place. That is why timing matters. Not perfect timing, but relative timing. Understanding when the environment is changing, even if the outcome is uncertain. Because the biggest disadvantage for most participants is not lack of access to information, it is delay in recognizing what that information implies. Right now, the implication is that risk is becoming more concentrated in specific areas of the financial system, areas that depend heavily on stable valuations, accessible refinancing, and consistent confidence. Regional banks sit at the intersection of all three. That does not mean failure is imminent, but it does mean sensitivity is higher than normal. And when sensitivity is high, small changes matter more. A shift in rates, a change in liquidity, a move in asset prices, each one has a larger impact than it would in a more stable environment. That is how stress builds, gradually at first, then more quickly as feedback loops begin to form. So the real takeaway is not a prediction. It is awareness. Awareness of how these systems behave, awareness of how capital moves, and awareness of where you are positioned relative to those movements. Because the sequence historically has been consistent. Institutional capital adjusts first, market pricing follows, public understanding comes later. And by that point, the opportunity to act early has already passed. Right now, you are somewhere in the middle of that sequence. The adjustments have begun, the signals are visible, but the broader recognition is not yet complete. And that creates a window, not an unlimited one, not a guaranteed one, but a window where understanding the direction of risk still has value. In the next video, I'm going to break down the specific institutions that are most exposed to these pressures, not based on opinion, but based on publicly available data that shows exactly how concentrated their risk profiles are. The same type of data institutional investors analyze before making allocation decisions. If you want to see that before it becomes widely discussed, make sure you are subscribed. Because once these dynamics move from positioning into headlines, the advantage shifts. And at that point, the conversation changes from what might happen to what already has. And by then, the move that matters most has already been made.